Let's take a look at the broader markets as we get set to close out the trading week. Joining us now, Lori Heinel, Deputy Chief Investment Officer at State Street Global Advisors. I'm going to assume that not that much has changed from the number that we just got for your overall view, Lori?
It is not. There was something for everybody there. I mean, obviously, the target number was a little bit lower than what we had anticipated. But in the end, you had wage growth was a little stronger. Labor participation looked good. So we think there was a lot to like in the number as well.
You've seen some things recently that maybe cause a little trepidation in your view, maybe whether it's trade or other things. And from a tactical perspective, you were underweight equities, but a modest overweight in U.S. large caps. So the underweight in equities is because of other parts of the world, emerging markets and Asia Pacific. But here you're still overweight modestly as long as it's large caps.
We are. And again, we've been laser focused this morning on the jobs report. And what does that mean for U.S. consumers? And the consumers have buoyed this economy into the late stages, and we think that will continue. But there are lots of things going on in other parts of the world, too. I mean, obviously, Brexit, there were some amazing developments there this week. You look at the Asia Pacific region and China growth slowing a little bit more even than had been anticipated. So there's not a lot else to like in equities around the world.
And you got a little more bullish on gold and also hedging strategies in general, because why?
Look at August. I mean, we've had an incredibly volatile period here. If you actually went away in May and came back at the end of August, you did okay across pretty much every asset class. But the choppiness here has been pretty dramatic. And so trying to stay long but put in place some buffers is something we think that investors should consider.
So we're in this weird netherworld where rate cuts may make sense with a 3.7% unemployment rate in an economy that's doing pretty well. But with inflation so low, maybe you don't do any damage by cutting rates.
I think that's spot on. I mean, we think that the Fed is going to raise rates in September. Thank you. We think that the Fed's going to cut rates in September because, again, it's not just about what the global backdrop is, but it's also about things like trade, concerns about that feeding into the real economy. And as you note, if you don't have inflation, then there's really nothing that stops them. And look, they could hike again. So if we get into a period where it actually looks like they've overdone on the downside, then they can always raise rates again. But we think they're going to cut in September.
You could also argue we're in a global easing cycle, and even though we have if we have a better economy here, it's still currency factors do make a difference. And if the whole world is cutting, and the yield differential is getting higher and higher, our dollar gets so strong. I mean, it's nice to bring assets here, or cash here, but there's a downside.
Clearly, the Fed is in a bit of a precarious position here because, on the one hand, if you just looked at the fundamentals in the U.S., you might argue that they shouldn't cut. But when they've also signaled, though, that the long-term trajectory is lower, that they are concerned about some of these global developments. So they're in this kind of situation where there's no downside to cutting, but in a certain way, it's unusual that they'd be cutting in this kind of environment. But as you say, you know, the dollar will still continue to be a safe haven. The dollar will still continue to be a good, attractive asset. And particularly if our markets continue to do better, that'll continue to attract capital.
We heard Steve say the run rate is 2 on the economy, and that anything that the trade wars or spats, whatever it is, whatever that is, you lower it from 2. Is that about right, or could we be at 2.5 and then you lower it from there? Where do you think we are? It's pretty solid, isn't it?
Well, I think one of the most important things to look at is the differential between manufacturing and consumer. And those things are diverging wildly. And why is that?
Manufacturing's 1.5 and consumer's 3 or something.
That's right. And so, you know, if you think that the consumer can continue to carry the economy, then a lot of this trade spat is just delayed investment. But if it becomes something more nefarious, then you're in a situation where you do have to worry about longer term, you know, lower trajectory for the U.S.